What if I told you one of the greatest companies on earth is a stock you should be trimming right now? Alphabet just posted 24% revenue growth, sits on roughly $242.5 billion in cash. And Warren Buffett's Berkshire Hathaway just made it their third largest position. And yet, after running the full analysis, our portfolio manager's verdict is a tactical underweight. Not a buy, not a sell, a trim. Today, I'm going to walk you through every single number behind that call. And by the end, you'll see exactly why $343 is not the price where this story gets bought. Let's set the stage. Our baseline date here is August 16th, 2026, with a reference price of $343.54 per share. And the core conclusion up front is this: Alphabet is in a midterm correction inside a long-term uptrend that has not been broken. Short and medium-term technicals are bearish. The fundamentals are a study in contrast. On one side, you've got powerful revenue growth. Second quarter revenue up 24.3% year over year, a rock-solid 34% operating margin, and that massive cash pile. On the other side, you've got enormous capital spending crushing free cash flow, an earnings per share cliff caused by a one-time investment gain, and a relative valuation that looks stretched. So the recommendation is to trim 30 to 40% of a position around $343, with 35% as the central target. Keep a 60 to 65% core holding, and wait for better price confirmation before buying back in stages. The long-term thesis: the search and YouTube advertising twin engines, Google Cloud, AI infrastructure, hidden assets, none of that is broken. But at this price, the margin of safety just isn't there. Now let's start with the technicals, because the chart is telling a very specific story. Here's the latest verified data from August 14th, 2026. The closing price was $343.54. That sits below the 10-day exponential moving average at $348.06. And below the 50-day simple moving average at $352.30. But here's the key: it's still above the 200-day moving average at $330.23 by roughly 4%. So short-term weak, long-term intact. The Relative Strength Index, or RSI, reads 46.27. That's neutral, leaning weak, and definitely not oversold. The MACD momentum indicator sits at negative 1.21, with the signal line at negative 0.83 and the histogram at negative 0.38. Translation: it just crossed bearish, but the momentum is mild and hovering near the zero line. Now look at the Bollinger Bands. The middle band is 345.44. The upper band is 376.28, and the lower band is 314.61. Price is sitting slightly below the middle band. The band width is about 17.9%, and the average true range is $10.61, which tells us volatility is moderate to elevated. And here's a detail that matters. Volume on that session was only 10.91 million shares, below the recent average. This is a low-volume grind lower, not a panic. Let's zoom out to the price structure. Since the May high near $398, the stock has been trapped in a wide downward-sloping channel. Each bounce has peaked lower, $398, then $370, then $375. And the lows have been bouncing around a zone between $318 and $335. This is not a one-way bear market. It's a corrective decline. So where are the battle lines? Key resistance: 348 at the 10-day moving average, 352 at the 50-day, and the zone from 370 to 376, which combines prior highs with the upper Bollinger Band. Key support: 345 at the middle band, 330 at the 200-day, and 318 down to 314, where prior lows meet the lower band. The read here is straightforward. Short and medium term, the bears are in control, and the downward momentum hasn't fully played out. But the long-term uptrend is still standing. And that low volume drift lower? It shows neither side has conviction. It's not panic selling, but it's also not confirmed buying exhaustion. Okay, now let's dig into the fundamentals, because this is where the story gets really interesting. The market cap is roughly $4.2 trillion. The trailing price-to-earnings ratio is 17.2 times. Sounds cheap, right? But here's the catch. That number is severely distorted by a $98.8 billion one-time gain on securities, which inflated the reported net margin to a jaw-dropping 54.8%. Strip that out and look forward. The forward PE is 23.3 times. The normalized net margin is around 26.9%, and forward earnings per share comes in near $14.75. Now compare that to the peer group. Alphabet's forward PE is higher than Meta's at 16.9 times, but lower than Apple's 32.2 and Amazon's 25.2. But look at free cash flow yield. Alphabet's is just 0.54%, and in the second quarter, free cash flow actually went negative, minus $5.85 billion. Compare that to Meta at 1.4% and Apple at 2.4%. That's a meaningful gap. And the PEG ratio? Nominally, it looks great at around 0.93, but here's the problem. The denominator is revenue growth, while earnings per share is in the middle of a normalization decline, so the actual attractiveness of that number is questionable. Let's hit the income statement. Second quarter revenue came in around $119.8 billion, up 24.3% year over year. Trailing 12-month revenue is about $445.9 billion, up 24.2%. Operating margin held steady at 34%. The core business is healthy. But, and this is a big but, the reported net income was massively inflated by that one-time securities gain. Which means over the next 1 to 2 quarters, reported earnings per share falling from $19.93 back toward normalized levels is a mathematical certainty. And that kind of drop can trigger scary headlines and algorithmic selling, even when nothing is actually wrong with the business. Now the balance sheet and cash flow. Cash and short-term investments total roughly $242.5 billion. Net debt is about $42.3 billion. The current ratio is 2.72. Financial flexibility here is extremely strong. But here's where the pressure shows up. Second quarter capital expenditure hit $44.9 billion, doubling year over year. And it's been accelerating for 5 straight quarters. 22.4 billion, then 24, then 27.9, then 35.7, then 44.9. Annualized, that's approaching $180 billion. That's what pushed second quarter free cash flow negative. And it doesn't stop there. Buybacks have been zero for 2 consecutive quarters, and the company actually issued roughly $30.5 billion in net equity. Shareholder returns have clearly shrunk. On top of that, property, plant, and equipment is expanding dramatically, which means future depreciation charges will gradually eat into that operating margin. But before you get too bearish, let's talk hidden assets and strategy. Alphabet's SpaceX stake carries a book value of about $94 billion. Think about that. a $900 million investment from 2015, now worth roughly 100 times more. Waymo's autonomous driving tech leads the field with its sensor fusion approach, and its commercialization progress remains a potential catalyst. Sergey Brin is personally pushing to double down on Gemini. And the rise of open-source models actually creates a structural sell-the-shovels tailwind for hyperscale cloud providers like Google Cloud. So here's the core contradiction. The current business has not deteriorated, but the company is in an unprecedented AI infrastructure spending cycle, and that's significantly weakened its short-term cash generation, while earnings quality faces normalization pressure. Let's shift to sentiment, news, and the macro backdrop. Sentiment is mildly bullish, but not euphoric. The institutional narrative is dominated by Berkshire Hathaway's massive second-quarter buying, roughly 48 million shares, worth about $37.8 billion, making GOE Berkshire's third-largest holding. And Greg Abel agreed to an additional $10 billion investment. Over on StockTwits, about 53% of recent messages are bullish, only 3% bearish, though mixed in you have technical warnings. The stock fell about 3.5% this week. There's a bearish engulfing pattern and talk of a possible bull trap. Reddit discussion is nearly non-existent, so the sample breadth is limited. On the news front, the positives: the Berkshire endorsement, the exploding SpaceX returns, Brin reinforcing Gemini, Block expanding its partnership with Google Maps, and Waymo's technical edge. The negatives and risks: thousands of lawsuits, mostly antitrust. Apple Maps advertising officially entering the arena to challenge local search ads. Long-term pricing pressure from open-source models, and rumors of AI talent movement. Now, the macro picture. It's a clear soft landing setup. Unemployment at 4.1%, recession probability only around 8%, and CPI running at about 2.95% year over year. But here's the catch. The probability of no rate cuts from the Federal Reserve this year is as high as 85%, and the 10-year Treasury yield is hovering at an elevated 4.63%. For a negative free cash flow, high beta growth stock, and Alphabet's beta is 1.237, that's a valuation headwind. So overall, sentiment is mildly bullish, but the weak short-term technicals and the rate environment cap the upside. Now let's look at the options market, because there's something hiding under the surface. The put-to-call open interest ratio is 0.84, and the volume put-call ratio is 0.54. Calls dominate both positioning and activity, so the tilt is bullish. Near-month skew is about negative 1.4 volatility points, meaning call implied volatility is actually higher than put implied volatility, and the negative skew gets deeper at longer maturities. The highest open interest expiration is September 18, 2026, with max pain at $340, right on top of the current price. But here's the data point you need to watch. The largest single-strike open interest is the $330 put, with 28,000 contracts. That's the most prominent concentration on the board. For comparison, calls cluster at 350 with 14,000 and 365 with 13,000. The interpretation: option sentiment is bullish, but that massive put open interest at 330 in a negative skew environment most likely reflects institutions selling puts to collect premium. If price touches that level, the dealer's delta hedging could turn that support into a downside accelerator. Short term, expect the stock to chop around the 340 to 350 zone while these positions digest. Now the bull versus bear debate and the final verdict. The bull's core case: over 24% revenue growth with a 34% operating margin, a relatively reasonable forward PE, more than $240 billion in cash, the Berkshire long-term endorsement, a 200-day moving average still rising, and AI cloud infrastructure plus hidden assets like SpaceX and Waymo that aren't fully valued. The bear's core case. A significant valuation premium over Meta with weaker free cash flow. An earnings per share cliff that's mathematically certain. Runaway capital spending plus zero buybacks plus equity issuance damaging shareholder returns. A coming depreciation wave that erodes margins. The 330 options level potentially acting as an accelerator. Antitrust and AI agents threatening the search click model as a body blow risk. And the reality that in a high-rate world, negative free cash flow high beta stocks get no valuation exemption. The verdict? The bears win on the key battlegrounds. Relative valuation, shareholder returns, options microstructure, and structural risks. And some of their arguments weren't fully rebutted. The bulls held the line on the current business, the balance sheet, and the long-term trend. Hence, a tactical underweight, not a sell, not a buy. The long-term bull case is intact, but $343 doesn't offer enough margin of safety to wait for the story to play out. So what do you actually do? Let's get practical. If you currently hold the stock, trim 30 to 40% near $343, with 35% as the execution midpoint, and keep a 60 to 65% core position. Your risk line: if the stock breaks below $330 on heavy volume and holds there, cut down to a minimum observation position of 10 to 20%. And near 330, absolutely do not catch a falling knife. If you're flat or sitting on cash from trimming, park that money in money market instruments yielding roughly 4.6% risk-free and earmark it as reload ammunition. Here's the three-tier buyback grid, and remember, price action confirmation comes first. Tier 1, the 333 to 330 zone. If you see low volume stabilization plus a reversal confirmation, like a big volume bullish candle or an RSI bullish divergence, and it's not a high volume breakdown, buy back 1/3. Tier 2, 318 to 314. The prior lows plus the lower Bollinger Band. If a panic sell-off stabilizes there, buy back another 1/3. Tier 3, 310 to 300 for an extreme value entry, or alternatively, if the stock reclaims 352 on heavy volume, that falsifies the bearish setup and you chase it from the right side for the final 1/3. Two more rules. If 330 breaks on heavy volume in a straight line drop, pause all buying and reassess around 310 to 320. And the admit you're wrong mechanism. If the stock reclaims 348 on volume and holds above 352, acknowledge the tactical error and buy back in. What would change the rating itself? To upgrade to overweight or buy any two of these three: capital expenditure peaking quarter over quarter, cloud growth matching Microsoft with quantifiable AI revenue, or buybacks resuming, plus the price holding above 352 on volume. To downgrade to sell, a volume break below 318 that isn't reclaimed within 3 weeks. The Department of Justice materially advancing structural remedies, operating margin falling below 30% with no capital spending guidance toward restraint, or the 10-year Treasury yield breaking above 4.75% and holding. Now the risks and the honest limitations. The main risks: headline shock from earnings per share normalization, capital spending and depreciation continuing to crush free cash flow and margins, a gamma squeeze at 330 accelerating a decline, antitrust action or a potential search business breakup, Apple's local advertising competition, AI agents potentially disrupting the search advertising model, and sustained high rates pressuring valuation. And full transparency, this report is built from internal analyst reports, debates, and the final ruling. Some data points, like Berkshire's exact cost basis, cloud segment details, depreciation schedules, the DOJ timeline, and Waymo revenue, carry citation or missing data risks and weren't externally verified in real time. So here's the one-sentence takeaway. Alphabet's long-term story is complete and its balance sheet is a fortress, but at $343, the risk outweighs the reward on relative valuation, earnings quality, capital allocation, and technical structure. Execute the tactical trim and hand the decision-making over to price confirmation at 330 and 314, not to faith in an AI vision or fear of a collapse. Now I want to hear from you. Are you trimming with the plan or riding out the correction for the long haul? Drop your take in the comments below. And as always, this video is for educational purposes only, not investment advice. Financial markets carry risk, so please make decisions based on your own risk tolerance and the latest earnings reports. I'll see you in the next one.